Okay, so for your homework, you had to do a CFI ROIC tree analysis on both Nokia and Ericsson. What's going to be very important, not only on this assignment, but all assignments going forward, the midterm as well as the exam, is that when myself or the TAs importantly grade this, you have to refer to numbers in addition to your analysis to get credit. If you just give analysis and you don't refer to numbers, I'm instructing the TAs to give you zeros, not even partial credit. All right. So if you just say Ericsson performance got worse over 5 years, that is a meaningless statement because that's a 50-50 probability as opposed to showing that you actually understand something. So the only way that you get credit is that if you refer to a specific number, so we know that you actually know what you're talking about when you make the statement. So again, the standard in this class is that you must constantly refer to numbers in your statements because without numbers, the statements are meaningless. All right, and I'll give you an example as I go through the solution, recommended solution to this assignment. So let's start out with Ericsson. So as we talked about, when you do a CFI analysis, two things are going to matter. Number one, there are 4 sections of the CFI. Operating, which is free cash flow, non-operating cash flow, debt, equity. You must talk about the 4 sections. Number 2, we said you start with free cash flow because that will tell you how your analysis is going to go. If free cash flow is positive, then the rest of your analysis, where'd the cash flow go? If free cash flow is negative, the rest of your analysis is primarily where'd the cash flow come from. Okay, so basically, we're going to begin and end the CFI with free cash flow because that's going to be telling to our analysis. In this case, gave you 5-year totals and major trends along the way. The difference between this assignment and where I expect you to be at the end of the semester with the group project is here we'll know that numbers are positive or negative. By the end of the semester, we'll know in the real world why they were positive, what changed. Okay, and I'll give you some examples as we go along the way. So, looking at Ericsson, total free cash flow, $24.8 billion of free cash flow over this 5-year period of time. It resulted because they had 104.3 billion euros of gross cash flow and about 64.3 billion of gross investment, giving them a reinvestment rate of 63%. Let me turn off my Wi-Fi. The Wi-Fi is having trouble today. Giving them a reinvestment rate of 63% over the 5-year period of time, resulting in free cash flow before acquisitions of about $40 billion. They spent another $15.2 billion on investments in goodwill and intangible, suggesting they did a bunch of acquisitions over that 5 years as well, giving them that overall free cash flow of 24.8 billion euros. Now, as we look at the years, we can see that the reinvestment rate was 23% in 2012, went to 70 in 2013, 60 in 2014, 82, and then 80 in 15 and 16 respectively. So basically it fluctuated between 60 and 82% between 2013 and 2016, up from the 2012 when it was 23%. We also notice that for the free cash flow and the gross cash flow, it took a precipitous drop between 2015 and 2016 from 25.2 billion euros to 11.9 billion of gross cash flow. They also cut their gross investment from 20.6 billion to 9.4 billion. And even though they maintained their reinvestment rate because their gross cash flow had fallen so much, and they did some kind of acquisition resulting in 3.3 billion of goodwill, it actually turned their free cash flow negative to negative 918 million. Okay? So even though they generated a lot of free cash flow over the 5 years, 2016 was obviously a very tough year for Ericsson. Looking at the non-operating cash flows, they took 24.8 billion of free cash flow and turned it into 44.8 billion of CFI. Primarily because they drew down their excess cash reserves by a little over $30.1 billion, $30.2 billion of reduction in excess cash. Now they spent, you can see this here, about $7 billion was basically coming from, negative $7 billion was coming from the loss from affiliates, and they also had about $4 billion of increase in non-operating assets. So net, that $10 billion of lost affiliates, $4 billion of non-operating assets offset the $30 billion of cash, and that primarily explained the $20 billion extra of CFI that they had available to distribute. Okay. Now, in terms of some other key items in here, $15 billion of the $30 billion of drawdown of cash occurred in 2016, which was also their financially challenged year. And most of the increase in the non-operating assets occurred in 2016, $7.4 billion negative in 2016. Now, with the $44.8 billion of CFI, what did they do with it? Well, they spent $4.6 billion on interest expense. Although it's been going down the last couple of years from $1 billion when they started back in 2012 down to about $640 million in 2016. They also decreased their debt by $4 billion, $4.3 billion. But interestingly, they increased their retirement-related liabilities by $13.7 billion. Most of it occurring in 2014 when it went up by $10.6 billion. So a lot of their financing actually came from underfunding what they owe their employees. Okay. Now, here's what I mean by the difference between now and the end of the semester. Right now, we know it's a problem. We know it's an issue. Like, why did they underfund their pension or whatever by $10.5 billion? All right. At the end of the semester, we need to know a little bit more detail. Was it related to something that they did? You would have read through the 10K. You would have read through the 10Q. You'd have done your homework to figure out what the big number change was. Okay, that's the difference in standard. Now we just identify trends. Later, we actually answer the trend. Same thing with acquisition. Saw a big increase in goodwill now. Later, I'll ask you, who'd they buy? Okay, and you should actually know, here's the companies that they actually acquired, which is why the acquisition was actually done in this period of time, and that was the increase in goodwill. So that's going to be the standard, because when you do your final projects, you have a lot longer to work on it as a team, so I'll imagine a little bit more depth. But here's the other thing. If this were real world, these would be setting us up for the conference call with management to ask the questions. So these would be the questions. All right, what'd you do that caused your pension obligation to go up so much? You know, why is the free cash flow negative? Is this a trend with your gross cash flow, or is this a kind of a blip or 1 year type of an issue? You know, what's happening with your reinvestment rate over time? So those are the types of things that will come out of this as questions. So we don't always have the answers, but nonetheless, we would do a little bit more digging beyond this homework exercise. So back to this. So the next thing we would notice, the big item here, is $51.2 billion or euros worth of dividends. And they constantly increase from 8.6 billion to 9.1 to 9.8 to 11.3 to 12.3 over the 5-year period of time. And so really almost all of the payout came from the dividends. And what's interesting is last year, when they had negative free cash flow, they really couldn't afford the dividend, because they paid $12.3 billion of dividend in 2016 on negative $900 million of free cash flow. So, and only 11.9 billion euros of gross cash flow. So it was really the drawing down of the excess cash that allowed them to pay that dividend. And if things don't change, that increase in dividend is probably going to be under pressure on a go-forward basis. All right, so that's what we know from Ericsson. Questions about Ericsson? All right, so just to be consistent with the analysis, let's talk about Nokia. So let's look at Nokia's CFI. Okay, so here is Nokia. Make it a little bit bigger to see. All right. So again, over the 5 years, about $7.4 billion of gross cash flow, about $4.8 billion of gross investment, resulting in a 91% reinvestment rate. They spent about $4.7 billion on goodwill, giving them negative $2 billion of free cash flow over the 5-year period of time. So again, with the negative $2 billion of free cash flow, where did the money come from to fund the gap? Now, before we get there, a couple of other interesting things about Nokia is that they had almost what looks like a bell curve, meaning gross cash flow went from $247 million to 581 to 4.1 billion, then it fell to 1.6 and then 859. So obviously 2014 was a peak year. 2014 was also a year where reinvestment went negative. So their reinvestment rate was inconsistent. So where Ericsson was pretty consistent, especially the last 4 years, around 60 to 80%, they were all over the map. They went from negative 175 to positive 263 to negative 1 to positive 68 to positive 300. So even though they averaged 91%, it wasn't a consistent 91% over the 5 years of time. And as I said, they had kind of a bowing of their financial performance, but really struggled in 2016 when they actually had an obvious operating loss and a big decline in their gross cash flow. And they also made a giant investment in goodwill and intangibles in 2016 of $10.4 billion, which sent their free cash flow negative by negative $12 billion. So basically they bought somebody big, and that somebody big would have been Alcatel-Lucent. Okay, so when Nokia sold in 2014 their handset business to Microsoft, they basically used that cash to buy later Alcatel-Lucent as they got their way into the back end of the cell phone market and networking equipment. They also bought a company called Withings, which is in the Internet of Things. They make smart devices like scales and or watches, which send, like you sit on the scale, it sends your weight to your phone, keeps track of it over time automatically. Or smart watches, if you're running, tracks your data over time. They 3 months ago rebranded it Nokia smartwatches, Nokia, scales, but it was a company called Withings or Withings that they also bought. But nonetheless, those were the two big acquisitions. So again, ended up with $2 billion of negative free cash flow over the 5 years, most of it occurring because of 2016 big acquisition. So what happened to their CFI? Well, they took negative $2 billion of free cash flow and they turned into negative $8.8 billion of CFI over the 5 years, primarily because and you can see this here, they had about negative $6.8 billion increase in non-operating assets. Right? So they obviously made, in addition to the acquisition, they made some big in non-operating asset investments, potentially into some joint ventures. Had to look and figure out what that is. They also, if we look at their cash, they drew down their cash by about $1.2 billion, $695 million in 2016, but again, over time about $1.2 billion over the 5 years, giving them negative $8.8 billion of CFI. Looking at the financing side, they paid €1.5 billion worth of interest expense. Although that interest expense was only $167.9 million in 2016, down from $334 million in 2012, because for 3 of the 5 years, they reduced their debt by about $1.294 billion, although they did have an increase in their debt in 2016 of $1.9 billion. Their retirement-related liabilities also went up by $5 billion, similar to Ericsson's, most of it occurring in 2016, but about $5 billion overall. And if we look at their dividends, they paid out dividends, but a little bit more inconsistently than Ericsson. Started out with $7.55, then they went to $71, then they went to $13.92, then they went to $5.12, then they went to $15.15. So they paid out $4.2 billion, but it wasn't consistent. It was like 2 big dividends, 2014, 2016. And because they had negative cash flow, where they funded the dividends was, number 1, the retirement-related liabilities, and number 2, they didn't really issue a lot of shares, but they had an adjustment to equity. That $12 billion and $12.1 billion in 2016 was likely, the way the model works, they probably bought Alcatel-Lucent for a combination of cash and stock. So that was probably the adjustment for the equity issued to make the acquisition, because the model had to figure out what the other equity is. So regardless, they basically issued the equivalent of $12 billion worth of stock and $5 billion from their employees to generally pay the dividend and fund the acquisition, most of which was spent in 2016. So there's your kind of CFI. But the important trend across 2 companies is big change in performance between 15 and 16s for the worse. And this is what I talked about at the industry level, the pushing out of the 5G investments by their customers and the heavy ramp up they've made in selling this. And they're kind of in a no man's land right now as an industry because of that. And I think they're really struggling. And you're seeing that in some of their numbers. All right. Now, let's talk about the ROIC tree. let's go back to Ericsson first. So again, when we go through the ROIC tree, as we said before, always 3 things that you must talk about to explain changes in ROIC. Again, EOY is end of year, so we're going from 2012, where Ericsson had a 14.5% ROIC, to 2016 when it fell to 2.5%. It was an 82.9% drop. So, reason number 1, taxes. Tax rate went from 41.7% in 2012 to 52.9% in 2016. That was an increase of 27% of the tax rate, which obviously hurt their ROIC. However, you can see their pre-tax ROIC still went from 24.8 to 5.3 and went down by 79%. So it wasn't really the taxes, even though that hurt them. It was their underlying business that worsened over the 5 years. And 53% is not a common tax rate. So my guess is, and again, we would have investigated this further, is that there was probably something merger related or otherwise, reorganization related, that gave them an abnormal tax rate in 2016. In fact, it looks like 2012 and 16 are outliers, and 13, 14, and 15 looks like more of the realistic tax rate, close to 29 or 30% longer term. But that being said, between 12 and 16, it did go up. Now, if you look at the pre-tax ROIC, drivers 2 and 3, margin and productivity. Operating margin went from 9.7 cents to 2.8 cents, a 71% decline in operating margin. So that really is what crushed their pre-tax ROIC. It was the big drop in operating margin. Productivity also worsened because in 2012, to generate $1 of sales, they spent 39 cents of invested capital versus spending 54 cents of invested capital in 2016 to generate the same revenue. So they did see a 36% decline in their productivity. But really, all 3 things were working against Ericsson. Right? They were less productive, they paid higher taxes, and they had a big plummet in their operating margins. But really, what hurt them most was the operating margin. Now, as we said, we have a second level of analysis. What was behind the drop in operating margin? Let's look at the income statement drivers. Gross margin went from 35.8 to 33.8. So they had a 200 basis point drop in their gross margin. SG&As went from 22.3 to 27. So they had an almost 500 basis point increase in their SG&A. And depreciation went from 4.2 to 4.0, didn't really change that much. So really, it was a combination of slightly worse gross margins, but importantly, big jump in SG&A, kind of like the jaws of death, clamping down on their operating margin. In terms of the balance sheet, operating working capital went from 12.5 cents to 19.4 cents, and PP&E to sales went from 5 cents to 7.5 cents, and intangibles went from 21.7 to 26.6. So 5 cents of intangibles per dollar of sales. They had about 2.5 cents of PP&E, and they had about 7 cents of operating working capital. So the 2 biggest drivers would have been the 7 cents of operating working capital was the biggest hurt to their productivity, although all 3 were unfavorable. And the biggest driver on the income statement operating margin was the big jump in SG&A. Okay? And a lot of that was between 15 and 16 when their margins went from 8.8 to 2.8. Or is it 6.8 to 2.8? 6.8 to 2.8. So basically, it was 15 to 16, which was the big change in their negative performance, which again is indicative of the same thing we got in the CFI. And seems to be an industry trend because Nokia had the same problem between 15 and 16. But let's look at Nokia's ROIC as well. Here is Nokia and their tree. So negative 22.4 in 2012 to negative 5.9 in 2016. It was a negative 73.8% drop. Somebody actually emailed me about this, and they said, well, it went down by 73.8%. Why is it negative 738? It was just the way the model calculates it. So it shows you it's a change. In this case, the change actually got better for them. So they went from losing 22.4 cents to only losing 5.9. So their end of year ROIC, though negative, actually got better over the 5 years. It was less negative, right? So in terms of the drivers, tax rate for them also hurt them because they went from a negative 25% tax rate, which means they got a refund, to a positive 33.4% tax rate, which means they started paying taxes. So obviously taxes are going to hurt them in that circumstance. Now the pre-tax ROIC did get better. Went from negative 18% to negative 8.8%. And again, it was kind of a Boeing effect, meaning it got really good, positive 52, and then positive 152, and then went back negative again in that final year. Now, as we look at the second and third drivers, operating margin went from negative 6%, 5.6, to negative 4.7. So they went to a little bit less of an operating loss. But again, that was after 3 years of operating profits, which peaked at 2015 at 13.7 and then plummeted in 2016 to negative, again, 5, which probably coincided with their acquisition of Alcatel-Lucent, and they hadn't gotten the synergies out of that messy acquisition. But nonetheless, really hurt their profitability. In terms of invested capital to sales, again, 31.3 to 53. Again, most of it went from 9 cents in 2015 to 53 cents in 2016. So again, probably acquisition related. In terms of the second and third level drivers, the gross margin and then the balance sheet, we basically have gross margin went from 44.7 to 42.6, which hurt the operating margin. SG&As again went from 43 to 40, which actually helped the operating margin, and depreciation went from 8.6 to 6.8. So the reason why they're losing less over that period of time is because they actually, even though they had a lower gross margin, they basically spent less on SG&A and less on depreciation. However, between 15 and 16, their SG&A went from 32 to 41, and that's really what kind of crushed them in the profitability side between 15 and 16, and then depreciation went from 3 to 7. Okay, so again, probably related to the Alcatel-Lucent acquisition. If you look at the balance sheet, working capital went from negative 14 cents to negative 2 cents, 1.8. So even though it's negative, it's less negative, which means they added a lot of working capital, more receivables, more inventory. So that probably hurt their balance sheet productivity the most. PP&E to sales went from 9.3 to 8.4. That actually benefited them. And intangibles went from 36 to 46. So they spent about 10 cents on acquisitions. But what really hurt them is about 12 cents more spending on working capital. So it went from more negative to less negative, which means a worsening of productivity. So again, biggest drivers for Nokia was the big ramp up in SG&A, particularly between 15 and 16, and the big jump in working capital and acquisition intangible expenditures. That explains their challenges that we see in the ROIC. Okay, questions? I know there's a little bit more than 500 words, but as I said, you will get better at this as you practice more, and this is what I mean by identifying trends as opposed to just talking about the summary categories. No questions about this? Great. So let me save this. I just recorded that. What's today? October 4th. This is CFI and Tree. All right.